Ever wonder how auditors navigate the intricate world of group audits? Today, we delve into the complexities of auditing multi-entity organizations. From unraveling interconnected financial threads to ensuring compliance across diverse entities, the task is both challenging and crucial. Picture this: a web of entities intertwined like a complex puzzle, each piece influencing the whole. To audit effectively, one must master the art of balancing detailed scrutiny with a holistic view. It's not just about numbers, it's about deciphering the story they tell collectively. Ready to explore the dynamic realm of group audits? Let's embark on this enlightening journey together. Welcome to today's learning journey. Ever wondered about the unsung heroes of group audits? Meet the component auditors, the backbone of auditing large organizations. Communication is key in group audit instructions, ensuring a seamless flow between auditors. Consolidation risks pose challenges in merging financial statements, but fear not, we'll navigate through them together. Lastly, group audit reporting, the final frontier where responsibilities meet deliverables. By the end, you'll grasp how auditors collaborate to scrutinize sprawling entities. Let's dive in and uncover the intricate world of group audits. Ever wondered what a group audit really entails? Picture it as a financial family tree, with a parent company overseeing various subsidiaries, divisions, or branches. The group auditor's task is to scrutinize the consolidated financial statements, merging all these diverse entities into a cohesive report. This complexity arises from the varied operations of each component, spanning different locations and even countries. Juggling these intricacies, the group auditor navigates through a maze of financial structures to ensure a comprehensive and accurate overview. In essence, a group audit is akin to unraveling a complex business tapestry. Why do group audits matter? Large corporations with numerous subsidiaries worldwide face the challenge of consolidating their financial reports for stakeholders. This is not just about scale and complexity, it's a regulatory necessity for public companies to provide a comprehensive financial snapshot of the entire organization. By undergoing a thorough group audit, all components are meticulously assessed, offering reassurance to investors and creditors alike. Ensuring accuracy and transparency in consolidated financial statements is crucial for maintaining investor confidence and demonstrating the organization's financial health. Ever wondered who scrutinizes the nitty-gritty of audit components? Meet the component auditors. These experts delve into specific parts of a group's operations, armed with local know-how and a keen eye for detail. Whether part of the main audit firm or an external entity, they focus on regional nuances, regulations, and languages. Their meticulous work feeds back to the group auditor, orchestrating the comprehensive audit process. With a finger on the pulse of each component, they ensure no stone is left unturned. Ever wondered how auditors decide which components to focus on during an audit? Not all components are created equal in terms of financial impact and risk. The group auditor carefully categorizes each one to determine the level of scrutiny needed. Significant components demand the most attention since errors here could seriously distort financial statements. Meanwhile, less critical components receive proportionate review to ensure accuracy across the board. This thoughtful classification system guides the audit process efficiently and effectively. In the world of auditing, every component counts, no matter its size. What makes a component significant within a group? Let's delve into two key dimensions. First, financially significant components drive a substantial portion of total assets, revenues, or profits. Imagine a subsidiary contributing 30% of the group's revenue. That's a clear example of financial significance. Second, even smaller components can hold weight if they reside in high-risk areas, like complex financial instruments or new markets, with potential regulatory impacts. Think of these as risk-based significance markers. Whether it's a major revenue generator or a risky venture, understanding these significant components is crucial for strategic decision-making. Ever wondered what it takes to be the group auditor? A crucial role that involves meticulous planning, precise instructions, thorough reviews, and the issuance of a definitive opinion. The group auditor must craft the audit strategy, identify components needing scrutiny, evaluate auditors' capabilities, and ensure clarity in directives and materiality levels. Every work paper and finding from component auditors undergoes a meticulous review, with a keen eye on gathering ample and fitting evidence. Finally, the group auditor signs off on the consolidated statements, a pivotal act that signifies the completion of a thorough and accurate audit. In essence, the group auditor is the linchpin to a successful audit journey. In the intricate world of auditing, the group audit instructions serve as the vital bridge between the group auditor and component auditors. These instructions are the blueprint that outlines the scope of work, sets the standards, identifies risks, and establishes reporting protocols. Without these clear directives, the risk of oversight or redundant efforts looms large. Imagine a symphony without a conductor or a team without a game plan. The success of the audit hinges on these precise instructions. Remember, clarity is key in the dance of auditing. Ever wonder what's included in audit instructions? From the scope of work to timing and deadlines, materiality levels to risk areas, and reporting format to communication protocol, it's all there. The scope outlines specific procedures and accounts to examine, while timing dictates when work should start and when results are due. Materiality levels set dollar amounts for investigation significance, and risk areas pinpoint focus areas. Reporting format details how findings should be documented, while the communication protocol outlines when to contact the group auditor. So, with these instructions in hand, the audit process is set in motion, ensuring a thorough and effective examination. Ever wondered how communication flows in group audits? It's not just a one-way street. While the group auditor sets the course, component auditors regularly update on progress, findings, and any hurdles they face. This ongoing dialogue forms a crucial feedback loop, enabling adjustments to the audit plan as needed. Picture this: if one auditor unearths unexpected fraud, it prompts a ripple effect, necessitating expanded procedures elsewhere. Check-ins and updates are the lifeline, ensuring the audit's trajectory stays true and nothing slips through the cracks. It's all about staying connected, informed, and adaptable in the quest for thoroughness and accuracy. Consolidation goes beyond mere number crunching. It's the art of harmonizing financial data from diverse entities into a cohesive whole. By scrubbing out internal transactions, we reveal the true financial picture of the entire group, not just its parts. Picture this: when one subsidiary sells to another, it's like a company talking to itself, interesting, but not revenue-generating in the bigger scheme. In the world of consolidation, clarity reigns supreme, cutting through the noise to paint an accurate portrait of the group's economic health. For our organizations to truly shine, we must consolidate wisely, revealing the real story behind the numbers. Consolidation can be a treacherous terrain, riddled with pitfalls waiting to trip up the unwary. Where do these missteps lurk, ready to derail even the most seasoned auditors? Often, the danger zones lie in the intricate web of technical accounting demands or the siren call of management's desire for rosy outcomes. Vigilance is key in these high-risk realms, where material misstatements can easily slip through the cracks. As auditors navigate this hazardous landscape, their focus must be razor-sharp to catch these potential errors before they snowball into significant issues. In the world of key consolidation risks, there are several critical areas that demand attention. Incomplete intercompany eliminations can sneakily inflate revenue or assets by leaving transactions unaccounted for. Foreign currency translation errors, especially in volatile markets, can skew financial statements. Inconsistent accounting policies across entities can lead to discrepancies in depreciation or revenue recognition. And let's not forget the importance of testing for goodwill impairment to avoid overlooking declines in asset value. Vigilance in these areas is paramount for accurate consolidated financial reporting. Ever wondered how auditors ensure the accuracy of financial consolidations? It's all about rigorous testing. They validate balances, test eliminations, and verify data meticulously. The group auditor meticulously reviews the consolidation work papers, traces balances, and samples elimination entries. Complexity is no obstacle. Special attention is given to areas like purchase accounting and non-controlling interests. And don't forget the disclosures. Auditors ensure all vital information about the group structure and subsidiaries is in the financial statement notes. It's a thorough process to guarantee precision. So, when it comes to consolidation procedures, attention to detail is key. Ever wonder how group audit reporting works? Despite component auditors doing much of the legwork, the group auditor ultimately holds the reins, taking full responsibility for the audit opinion on consolidated financial statements. Investors place their trust in the group auditor's expertise and judgment, as the final say rests in their hands. While component auditors may not be specifically named in the audit report, their contributions are vital to the process. It's the group auditor who meticulously reviews their work and ensures the consolidated statement's accuracy. In the world of audits, it's the group auditor's reputation that shines through, guiding investors towards sound decisions. Takeaway: the group auditor's oversight and final determination shape investor confidence in consolidated financial statements. Are you ready to dive into the heart of audit reporting responsibilities? It's time to assess the sufficiency of evidence gathered, ensuring it supports the final opinion. Next, we meticulously review the work of all component auditors, guaranteeing quality and completeness. Communication is key as we discuss significant findings and required adjustments with management and governance. Finally, the culmination of our efforts, issuing the audit opinion that determines the fairness of the consolidated financial statements. Each step is crucial in upholding the integrity of the audit process and ensuring accurate financial reporting. Remember, precision and thoroughness are our guiding principles throughout. When the audit path hits a bump, the pristine unmodified opinion can turn elusive. Material misstatements uncorrected by management, inadequate evidence, or doubts on the company's future can cloud the audit waters. Component auditor hiccups can also tint the group opinion, like being barred from vital records or doubting a component auditor's work. Scope restrictions may lead to modifying the group audit opinion. In these murky waters, clarity can be hard to find. Ever wondered how a group audit works? Picture this: multiple auditors collaborating under the guidance of a group auditor, who bears the ultimate responsibility for the consolidated financial statement opinion. The key? Clear communication. Detailed instructions ensure each component auditor knows their role in assessing scope, timing, materiality, risks, and reporting requirements. But beware of unique risks in consolidation. Think incomplete eliminations, currency errors, policy inconsistencies, and goodwill oversights. Despite component auditors performing the legwork, it's the group auditor who signs the report, owning the consolidated statement's opinion. Remember, in group audits, clarity and coordination are paramount. Imagine being the group auditor for Global Tech Corporation, overseeing a complex web of subsidiaries across the globe. With 3 major revenue drivers and 2 subsidiaries navigating turbulent markets, the stakes are high. As you evaluate significance, consider the potential impact on consolidated financials. For the high-risk markets, provide clear directives to component auditors on risk assessment and fraud detection. Consolidation risks, especially related to intercompany transactions and balances, should be scrutinized. If fraud is uncovered in a major subsidiary, swift action is crucial. However, even evidence from a small sales office must not be overlooked. Remember, the integrity of the audit opinion hinges on obtaining sufficient evidence from all components. Engage with your peers, drawing upon our discussion to defend your audit strategy decisively. And in the world of auditing, thoroughness is non-negotiable for ensuring the accuracy and reliability of financial statements.